3 Golden Rules of Accounting. The 3 Golden Rules of Accounting are as follows. Rule 1. Personal accounts. These are general ledger accounts of individuals and organizations. In these accounts, debit the receiver and credit the giver. Rule 2. Real accounts. These are permanent accounts that do indeed close at year-end. In these accounts, debit what comes in and credit what goes out. Rule 3. Nominal accounts. These are temporary accounts closed at each year-end. In these accounts, debit expenses and losses, credit income and gains. Types of accounts explained in detail. Personal accounts. The account of an individual, group of individuals, firm, company, or institute is a personal account. There are 3 types of personal accounts. Natural personal account. Accounts of natural persons, i.e., accounts of particular human beings, for example, Sam A/C, Molly A/C, creditors A/C, debtors A/C, drawings A/C, etc. Artificial personal account. These accounts do not have the physical existence of a human being, but a group of human beings working together, for example, trading AC, company A/C, partnership firm A/C, bank A/C, trust AC, club A/C, etc. Representative personal account. When an account represents a particular person or group of persons, then it is called a representative personal account. It implies that debit the person's account who receives something from the business out of a transaction and credit the person's account who gives something to the business. If goods are bought on credit from a supplier, the purchaser's account is debited, nominal, and the supplier's account is credited, as they are the giver. Debit the receiver, credit the giver. 2. Real accounts. The accounts whose value can be measured in monetary terms, whether tangible or intangible, which belong to the business, are called real accounts. There are 2 types of real accounts. Tangible accounts. The real accounts which can be touched, felt, measured, purchased, and sold. For example, cash A/C, stock A/C, furniture A/C, machinery A/C, etc. Intangible accounts. The real accounts which cannot be touched, but their value can be measured in terms of money. For example, goodwill A/C, patent A/C, copyright A/C, trademark A/C, etc. The rule specifies that any real account which comes into business is debited, and any real account that goes outside the business is credited. When office furniture is purchased with cash, the furniture account is debited as it comes in, and the cash account is credited as it goes out. Debit what comes in, credit what goes out. 3. Nominal accounts. All the expenses and losses as well as all the incomes and gains come under nominal account. Expenses include salaries paid, rent paid, discount allowed, etc., and incomes include commission received, interest received, discount received, etc. It implies that all the expenses and losses incurred in business are debited, and all the income and gains should be credited. For example, when paying rent, the rent expense account is debited, and the cash account is credited, as cash is going out. Debit all expenses and losses, credit all incomes and gains. Benefits of the Golden Rules of Accounting. 1. Clarity. By adhering to these rules, accounting transactions are recorded in a clear and consistent manner, making financial statements easy to understand. 2. Accuracy. The rules provide a structured approach to recording transactions, which helps in minimizing errors and maintaining accurate records. 3. Consistency. They enable consistency in recording financial transactions, ensuring comparable and reliable financial statements over time. 4. Decision-making. Accurate and consistent financial information allows management and stakeholders to make informed decisions based on the financial health of the organization. 5. Regulatory compliance. Following these rules ensures compliance with accounting standards and regulations, helping avoid legal and financial penalties. 6. Financial health assessment. They help in accurately assessing an organization's financial health, aiding in effective financial planning and analysis. 7. Audit-ready records with less hassle. A well-maintained accounting system is easier to audit. 8. Aligns with GAAP standards. The Golden Rules form the practical steps for applying generally accepted accounting principles, GAAP, the global standard for financial reporting. 9. Comparison of financial results. Golden accounting rules make sure that the financial results are properly recorded. This lets businesses compare the financial results year over year efficiently. 10. Detailed business valuation. When a company calculates its financial statements properly, it makes the business valuation well-defined. Furthermore, it makes getting more investments easier while expanding the business. 11. Helps in future estimates and budgeting. If your business has a sound budget based on the best accounting practices, it builds a strong pillar for growth. Additionally, it helps in gaining more projections. 12. Evidence for legal concerns. Recording financial information is highly recommended for prompt reference during lawsuits. With golden accounting rules, this becomes handy and systematic, serving as solid proof for legal purposes. 13. Assistance in tax-specific matters. Lack of proper accounting practices could lead to huge penalties. This also negatively impacts the brand value and image. Accounting a firm's financial statements helps companies to prevent shortfalls in taxes. Thank you.